Welcome everybody to our Leaders in Housing Counseling call. Very glad to have you all on. We have a lot to do today, but just going to take a quick moment and just acknowledge we went off our regular schedule of calls, had what I thought was deeply meaningful call last Thursday that really tried to get our arms around the best way we could around all the deep issues that are dealing with this country and with in the wake of the George Floyd killings and others, and the whole conversation around race and around housing counseling in our work. And it means a lot, and I want to just acknowledge the great contribution of the panel, but also the deep and thoughtful engagement that we had from so many of you. And I think we appreciate the letters and emails that we got from a number of you afterwards. I mean, it does help frame this all up. It does, I think, remind me and I think others as well about why this work is important, and it's a piece of the puzzle of solving some of the deep racial problems in this country, and grateful that I get to work with you all to do our piece to this. So thanks for all of that. We are going to try to go back to a more normalized schedule. So I think that would, so we're at least we're talking among the staff about trying to do calls every 2 weeks or twice a month, as opposed to the usual, what we've been doing since the beginning of the coronavirus, which was weekly. And so we'll see how that works. We will definitely jump in more frequently when anything becomes relevant and needed. So we want to be useful at the right time, and we always want to be timely. So, you know, and again, appreciate input that people shoot us about what would be helpful for you to know. We're thinking about what the next steps are to help your work more effectively in these times. And so your input is really helpful. What we're going to do is I'm going to go back to our legislative updates, and Melody will catch you up on a lot of the good work she's been doing and her partnerships. It's been a lot's happened since we last talked. Most of the call will be on after forbearance, how do you deal with taxes and insurance? And it's a complicated issue. I'm glad we're getting such a good turnout for this call. It must feel something in the weeds, but it's critical, and we need to be experts in this. And we'll use this. This will be a resource that people can refer back to. And just a reminder, if with all of our calls, they're recorded and they're posted on our website in the media library. There's almost all the calls I get, certainly during the coronavirus, there's always at least a handful of people who email about, was it recorded because I couldn't make it? And yes, it is. So rather than checking with me, just go to the website. Melody and Ellie get it up usually by Friday afternoon. Takes a little bit to upload, but we're on top of it. We'll do a quick plug on NHRC membership. And listen, we understand that times are tight, and if this isn't the right time, you know, we can be patient in all this. Really appreciate that so many people have renewed, and this time we just got in 3 new memberships in the last 2 weeks, which is just great to be growing at a time when there's so much pressure on everything. We really appreciate that. We just shot out on Monday a membership renewal notice. We hadn't done that in a little while, and got a very warm response to that too. And you know, I appreciate that too. We're planning on our next call being on the 16th, so the idea would be get back onto that schedule twice a month. We're not going to do one the week before 4th of July. If there's a quick emergency, we might do something on the 9th, but it's not planned right now. So that's our plan, and we're hopefully going to stick to it. Okay, so please, Melody, tell us what's going on the Hill and all the housing legislation you're working on.
Thank you. The really big news that we're super excited about is that, and I just got an email in my inbox from staff in Senator Menendez's office, is the introduction of the Coronavirus Housing Counseling Improvement Act. This is going to be sponsored by Senators Menendez from New Jersey and Brown, who is ranking member of the Senate Banking Committee. I think this is a culmination of months, if not years, of working hard to build the reputation of housing counseling in both chambers, but especially the Senate. I got word that this bill is scheduled to be introduced next Monday. But we're really, really excited that we have these two great champions in the Senate that are serving as advocates for the housing counseling field and its consumers. Next slide. So what is this bill? We talked about this bill briefly, that it was in the works, and we're happy that it's finally going to be introduced, but it ultimately authorizes $700 million for funding through NeighborWorks to support housing counseling services during the COVID-19 pandemic. It also includes equipment and technology as eligible expenses. Next slide. So this legislation was based off of Representative Axne, Democrat from Iowa's bill that was introduced in the House and was included in the list of proposed priorities from House Financial Services Chairwoman Waters. It was originally going to be introduced in the HEROES Act, but ultimately the HEROES Act came out with $100 million for housing counseling. We worked very closely with both House Financial Services and Representative Axne on that legislation, and we're working very closely with Senators Menendez and Brown on their legislative language. So we're very much in support of the legislation, and we're excited that Senators Menendez and Brown recognize that while $100 million in the HEROES Act is great, and we're very grateful, it's almost double the amount of fiscal year 2020 funding, which was $53 million. We're excited that people have recognized that the need is that great, and $700 million would be a great injection of funding for the field. Next slide. And before I jump into FY 2021 approach, the logic behind the $700 million was, and through NeighborWorks, was that they wanted to model this funding similar to the National Foreclosure Mitigation Counseling Program during the Great Recession, which across roughly 10 years was about $800 billion of funding, and they felt like they can have something similar through the coronavirus housing counseling bill. So we're very, very excited about that, and looking forward to its introduction. We worked really closely with both offices on potential co-sponsors, focusing primarily on the banking committee due to needing those who are authorizers relevant to the jurisdiction of housing counseling. While we've been very busy working on coronavirus-specific housing counseling legislation, surprise, Congress decided to drop back into their schedules fiscal year 2021 approach. We got word that over at the House, the House Transportation HUD markup is scheduled for Wednesday, July 8th at 11 o'clock. That bill covers the funding for the Housing Counseling Assistance Program. Bruce and I are in very good relationship with Sean Maxwell, who is LD, Legislative Director, over at House Appropriations, THUD Subcommittee Chair, Representative Price from North Carolina, as well as the Ranking Member Diaz-Balart from Florida. We feel pretty confident that they'll have a pretty reasonable number for housing counseling. We just don't know that number yet. It will depend on the exact allocations given to each subcommittee, which determines the ceiling, if you will, for funding for each funding bill, and then they decide appropriately how much each individual program will get. So given that there is a pending eviction crisis in the U.S., affordability crisis in the U.S., now, surging unemployment numbers, we think that people will have a very much renewed interest in housing, as we've been hearing from other partners and advocates in this space. And we're hoping that housing counseling gets a sort of a boost in terms of priorities with lawmakers in the House and in the Senate. Next slide. So what we've heard is that House Democrats plan to build on the HEROES Act during fiscal year 2021 approach. As I said, that the number that passed the HEROES Act for housing counseling was 100 million. So it was best case scenario. They recognized we would just want the funding levels from the HEROES Act, which was designed by Speaker Pelosi and her chairs, something similar. But again, no one's telling us anything on what exact numbers are. We won't see legislative text for the markup until, I believe, 1 or 2 days before the markup is scheduled. But once we get the exact number on what they're working with, I definitely will be sending it out to members and partners, but I'm hopeful. Next slide. So that's our strategy in the House. We feel pretty good there, and we definitely feel that we've covered our bases. The primary issue we keep running into seems to be on developing a strategy with Republican members of the Senate. We've had great conversations with different key offices, so committee leadership, major players, both sides of the aisle, people who are seen as leaders in the housing space on the Republican side and the Senate, the banking chair, Senator Crapo, as well as Senator Shelby, who is chair of Senate Appropriations. Excuse me. And we seem to be sort of hitting a wall in the sense that there's just so many conflicting priorities in the Senate that it's hard to elevate what is considered to be a relatively small program sort of to the upper echelon of this has to pass. So if you think of it comparatively, community development block grants send millions and millions into lawmakers' individual districts and states, whereas the Housing Counseling Assistance Program last year had $53 million. So while we will say that $53 million is a great sum of money, I can't even tell you what I would do with $53 million right now. To lawmakers who are working on billion-dollar budgets, it's relatively small pots. So it's kind of a good thing in the sense that because we are relatively unknown, we're safe from being zeroed out. But the downside is that when we try to make the case to senators to increase our funding, it's really hard for our voices to sort of rise above. So we are continuing to work to increase the visibility of housing counseling, to improve its ranking to appropriators and authorizers. And just to clarify, appropriators actually submit the dollar amount, if you will. The authorizers are the one who say they're authorized to do so. So authorizers would be banking and financial services in the House, and then appropriators would be, of course, House and Senate appropriations. Next slide. So we're asking people to advocate for housing counseling funding. This is the time. They will definitely go into August recess sooner than you think. I feel like 2020 has just zoomed by. So time's going way faster than we think, but especially on Capitol Hill. Those are two links to help you find contact information for your Senate and House members. If you would like to have more specific contact information, please feel free to reach out to me. We have a database of lawmakers, individual staff. I'm happy to help. And, you know, definitely make the case. This is the time. Let lawmakers know who you are, what you're doing in their communities, and the impact you have on their constituents' lives. Next slide. So making the case. Right now, the focus on Capitol Hill, particularly around housing, is the concern on eviction and foreclosures. So while everyone was hunkering down during the pandemic, and I know we have some reopenings happening around the country, but overall, there's been several moratoriums across the country on the state and local levels around evictions and mortgages, and many of them are starting to lift. The concern now from many advocates is that when these moratoriums lift, we're going to have this huge surge in evictions and foreclosures potentially around the country. And what will that have? What impact will that have on local economies? What impact will it have on people's bottom line and overall wealth profile? So explaining the potential impact on these crises to lawmakers and the role that you serve in preventing such, honestly, economic disasters. Really making the case that you can't do the work that you do, the great work you do with their constituents without an increase of funding and operational support. Next slide. That is not my phone. Okay. All right, I will ask everyone to mute if they aren't me. Okay. Next, provide them with current data. Lawmakers absolutely love data. They are able to share amongst their staff, and they can use it to quantify the case to their legislative colleagues, showing them how many households you help, diversifying the kind of counseling you do or have done, particularly during the crisis, but just during a regular year. While people are talking about housing counseling, I always stress that the appropriations is a year-long effort. They will prioritize the funding for programs that they are always hearing about, and not just once in a blue moon or once during the year. And so really making the case that throughout the year you've worked on this kind of renter counseling. Homelessness is a huge issue on the Hill right now, whether it's sheltered or unsheltered homeless. Have the data really break down, if you have it available, by race, by age, by zip code, by even household status. So if you're serving primarily young married couples, if you're serving seniors, lawmakers love that kind of data. Always be willing to share that information and share it with NHRC as well. We love hearing from groups and advocates. We like to save that information so that if we're reaching out to a very special key office, we had that information to provide them already. Next slide. And as I said, if you make that connection with a House or Senate member, let us know. We might have a relationship with that office, and it just helps coordinate and facilitate the larger conversation around funding, but also other potential housing counseling opportunities. We had one example here in Philadelphia. A CDC reached out to the lawmaker, and now she is very much a supporter of housing counseling certification. So you never know who could potentially be a champion for this issue, which is why connecting with lawmakers matters. It's why it's important to be educated on what's going on at the federal level and really having a voice, not just with your DC legislative staff, but also your local staff. Every single Senate office and House member has a local office, and having a relationship with them is just as important. And if you're able to ever make inroads with DC or local staff, we would love to know, and we would be happy to help. And I think that's everything for me, and I'll turn it back over.
Thanks so much, Melody. Really important, and it is our lifeblood, and we really need to figure out how to get more funding in. And we think that there's real opportunities in the coronavirus, in the COVID-19 legislation coming up. So special effort in reaching out to your senators right now who are Republicans would be really helpful, because they will be the ones who decide what really gets in the bill at the end of the day. We do have bipartisan support, so that's really good, but we need more champions, so you can help with that. I'm going to jump off the agenda just a little bit to mention a couple things I know are top of mind to some people, and just because such the nature of our work, and then we're going to jump into the main agenda. This will only take a minute, but I know we continue to get concerns, and there's a lot of talk about certification and counselor certification. Will the deadline be extended? And it's frustrating to all of us that we've not gotten an announcement yet. um, everything, all the signals that I'm seeing and hearing and activities that I hear about from HUD sounds like this is moving forward, and that it's, I have not heard any indications that we're in trouble of this. So I'm thinking this will come through. I wish it would happen earlier, but it is what it is. So I want to make sure that people understand that if it was not going to happen, we probably would have known that a while ago. We've had a number of indications that HUD is taking this seriously, starting with Brian Montgomery when he came onto our call way back in March, where he immediately acknowledged all the challenges to being able to do the test and do the studying in the world of shutdown from COVID-19. So I do think things are moving forward as far as I can tell. There's not been any negative signal at all. The other thing is that for those of you who handle contracts with HUD, contracts have shown up and you got your awards, and congratulations. And there was a breakdown in that you get your award, which is a substantial part of money, and then there's a separate category called counselor certification, parentheses, exam fees. And so that is the breakout that HUD has done on the contract. It's because of the up to $3 million requirement in the last budget bill that said that up to $3 million could be spent on certification. And so what they ended up doing is defining certification as the fees that you do on the testing, because that's clearly only certification cost. Other costs are actually much more complicated. So training, any kind of trainings, you can't intersperse them. They would need to somehow be separated out. So all the other kinds of expenses you might apply couldn't be done as cleanly. There need to be a way to get the money out. So that was the solution, as I understand it, or kind of pieced together from what I understood the dilemmas to be. So so it is what we've got in the world of our of funding. So certainly use it for the fees, and my understanding is that we won't be able to use it for other things. So let's move on quickly onto our main topic. So Ellie, why don't you take it from here?
Thanks, Bruce. Hi, everybody. So we're going to spend some time today talking about taxes and insurance, specifically as it relates to the forbearance program that many homeowners are engaging in right now. And we're going to start with Lisa Sitkin, the Senior Staff Attorney at National Housing Law Project. Lisa's been on a few times with us and always does a really wonderful job of explaining things in a way that's easy to understand. So Lisa, take it away.
Thank you. Hello, everyone. So I want to say a couple just preamble things first. The first is that this can be a sort of complicated, thorny topic, escrow accounts and taxes and insurance and how they get dealt with in many scenarios, but certainly in the one we're in right now. So I just want to acknowledge that this is going to be a brief overview, and that my intention here is really to flag issues that people should be aware of, rather than trying to sort of explain everything deeply or, you know, address particular scenarios in a lot of detail. But I just want this to be on people's radar, and it's certainly a conversation we can circle back to if needed in the future as borrowers start to come out of forbearances and this becomes kind of more, you know, salient and urgent. And then the other thing I want to say is that I don't think I added my email here, but I am available for housing counselors. I usually work mostly with, you know, providing consultation to legal services attorneys around the country on mortgage and some rental issues, but please feel free to contact me as a housing counselor as well. I worked with many of you back when I was at HERA in Oakland, and I very much value the work that you do and want to be as supportive as I can be as we move forward through this very strange crisis that we're in. So having said that, in my email, it's pretty straightforward. It's L and then my last name, Fitkin, at nhlp.org. And I also wanted to say that our website, nhlp.org, has a whole section of COVID resources, a small section on homeowner issues, broader than what I'm talking about today, and then a lot of information specifically about renters and evictions and other related issues. So please feel free to take a look at that. Okay, so we can go to my first real slide. Thanks. So I just want to sort of set the scene here. The reason we're talking about this is that Ellie and I and others have been participating in some weekly calls for the past few months where counselors and consumer advocates and folks from servicing associations and servicers themselves have been discussing kind of the hot issues that we're seeing as the COVID crisis sort of moves forward and what we're projecting. In those conversations, obviously one of the things we're paying a lot of attention to is this question of what happens when people come out of forbearances and what that's going to look like, and tracking what the various agencies have done in terms of giving guidance on the options that borrowers will have, and of course talking about what non-federally backed borrowers' deal is. But one of the topics that emerged there is that for some of the post-forbearance options, and particularly this relates to the GSE's COVID-19 payment deferral option, which I'm not going to discuss in a lot of detail. I'm going to either assume wrongly or rightly that you guys have discussed that, or if not, that you will do so. But let's just say it's kind of the main option for people who were current going into a COVID forbearance or CARES Act forbearance, and who are able to resume their payments but need to deal with the arrears. So for that option, there are some wrinkles regarding how escrow accounts will play out, and how escrow payments, might change after the delinquency, the post-forbearance delinquency has been resolved. And so what I wanted to do today is talk through kind of what are the factors that are going to affect whether this problem arises for any given borrower. That's what this first slide is about. And then to just compare, to give a little bit sharper focus, what that looks like in the context of the GSE option versus an FHA partial claim, or COVID standalone partial claim, I think it's called, and how that might play out differently for a borrower. And then I have a very short sort of sample just to show you kind of how different it can look depending on how long a forbearance was and different other factors. So this is just a list of the factors that are gonna, affect how a borrower's escrow payment may be affected. And the thing I'll say, what we're trying to understand and be prepared for is the fact that there are going to be some borrowers who come out of a forbearance, and although the goal of these, sort of new or modified post-forbearance options that are out there is to get people back paying, what they were paying before they went into forbearance, for certain reasons, it may be that some borrowers are actually going to be hit with some payment shock because the escrow payment might go up. We're hoping, this will be a smaller group than, a small group within the whole universe of people who are going through all this, but it's hard to know that because of these different factors. So what's going to drive this is, the type of loan. Is it GSE? Is it FHA? Is it non-federally backed? And then which post-forbearance option is actually going to be used. The length that somebody was on forbearance, length of time, is going to be a big driver also for reasons we'll discuss in just a moment. the timing of when the servicer performs an escrow analysis, the timing of the due dates for escrow disbursements, when those property tax and hazard insurance payments are due, and then the length of the escrow shortage repayment spread that the servicer uses. Because at least as I understand it now, and I'm sure Courtney and Hugh can speak to this more thoroughly, but there's a fair amount of flexibility and discretion given to the servicers, particularly on the GSE side, in terms of how long of an escrow, if there is an escrow shortage, how long that repayment period is going to be. And I think different servicers are thinking about that differently. So, Hugh and Courtney, I'm sure we'll talk about that. Next slide. Excuse me. Okay, so this is just giving you a little snapshot. If the borrower has an FHA loan, and again, I want to be clear that we're talking about, a particular universe of borrowers. These are borrowers who were basically current or less than 30 days, kind of going into the crisis and before they went on forbearance, and then who are able to resume making roughly, their same payment coming out. There are lots of other bells and whistles and wrinkles for people in different situations than those, but that's who we're talking about here. So the FHA has come out with this COVID-19 standalone partial claim. And what that does is it allows the servicer to actually capitalize the full PITI payments and any escrow advances. And the effect of that is that you're going to end up with, I think of it as less of a hole in your escrow account than you might have had otherwise, because during, let's say, a 6-month forbearance, you weren't making, your PITI payments. And this is, there may be some people who are making partial payments, and it'll obviously look different for them. But for most people, they're doing a 0 payment forbearance, and it's helpful in this context that the FHA allows for that full PITI payment to be rolled into the non-interest bearing payment that's getting capitalized and just going to sit there till the end of the loan. So the result of that, at least as I understand it, is that somebody who has an FHA loan and gets this option at the end of forbearance is going to be able to return to making essentially their same regular PITI payment. The only adjustment will be the adjustment that would have been whether they had forbearance or not, right? Because, property taxes and insurance can change from year to year, and there are always slight adjustments, usually increases in those escrow payments, but they're generally gradual. So that should, for that population, that should stay the same. The wrinkle, the big wrinkle comes for the GSE COVID-19 payment deferral, which looks a lot the same as a partial claim, right? The idea is to take those arrears, put them in non-interest bearing, add them to the balance, but make that non-interest bearing, and then you have a balloon payment due at the end. But the issue is that for the GSE payment deferral, the servicer is only permitted to capitalize any escrow advances. So any, if they paid a property tax bill out of the servicer's pocket or paid the hazard insurance out of the pocket during that forbearance period or before this option goes into effect, they can capitalize that along with the principal and interest payments. But if there is an escrow shortage, which is essentially they look at, what's in your escrow account and they project what's going to need to be paid out, when the bills come due. And they say, oh, there's a certain balance you have to be at to have the money in the escrow account to be able to for us to pay that out. If that comes short in terms of their projections, that's called an escrow shortage. It's different from, having a negative balance or having had them pay out the actual tax bill, that's usually referred to as a deficiency. And again, I'm not going to get deeply into the weeds on this stuff, but there is this kind of shortage in an escrow account that can lead to payment shock and result in an escrow payment going up by quite a bit, and that cannot be included as part of the capitalization in the payment deferral. So another way of putting it is they only allow principal and interest, not the taxes and insurance, except to the extent that the servicer has actually advanced these payments out the door. And then for, based on the factors that I discussed a moment ago, there are going to be differing outcomes to how that plays out for any given borrower. I did want to say that my understanding, and again, Courtney and Hugh might be able to confirm or clarify this if I'm misunderstanding, but that is for when servicers are servicing non-federally backed, like private label security loans and things like that, it sounds like their intention is to try to track closely to the GSE approach, unless an investor won't allow that. But that means that this model, this payment deferral model, which, as I'm discussing, is going to leave some questions or a hole in that escrow account, may be what's used for a bigger part of the market than just GSE loans. The other thing I wanted to note quickly is that, we're fast approaching July 1st, which is when the payment deferral program goes into effect. Until then, I guess if people were coming out, I don't think there are very many. There are different GSE options available, and they may play out differently in the escrow context. So I know I'm taking a lot of time here, but I just do want to focus us on this one example. So what it would look like for somebody who has a Fannie loan going into the forbearance. I've laid out here what the numbers are for their payment. And then I've given you, their current year's property tax bill and hazard insurance, and then what that's going to be next year. This, I have to say, I'm in California. This is not a California set of numbers for the most part, but I'm trying to just, make the math easy and not be too crazy with the amounts. And then I've given, just just to give us some purchase, a due date of taxes and insurance both being due by February 10th. It's usually not going to be the same, but for purposes of our example. And then that the escrow analysis is generally run on March 15th each year. One thing to note is this doesn't include an escrow cushion. As I'm sure many of you know, servicers are permitted to include up to 2 months worth of a cushion in the escrow account, which is basically, the idea is that because taxes and insurance are going to go up from year to year, you kind of build in that cushion so that you don't end up with these shortages rolling over again and again. Some servicers do that, some don't. So I left it out here, but obviously that will to some extent amplify, whatever increases in payments that somebody's going to see, because it's not just, like 1/12 of the property tax bill, but it's 1/12 plus, some more for the cushion. So that's our fact pattern. And let's just go on to how that's going to play out for somebody. So if this person never went into a forbearance, their tax and insurance payment is going to go up by about $690 anyway. So they're going to see just under a $60 a month increase in their escrow payment. So that's going to happen regardless. That has nothing to do with forbearances, COVID, CARES Act, anything. That's sort of just the status quo. But if somebody goes into a 9-month forbearance, and again, we're talking about somebody with a Fannie loan, so we're looking at that GSE payment deferral option. They go into a 9-month forbearance starting April 1st of this year. When they come out of that forbearance, they're going, assuming again, they're paying zero, they're going to have an arrears on their tax and insurance on their escrow payment of about $3,300, $3,400 almost. And when the next escrow analysis is run, which in my example isn't going to be for a few months after, servicers are allowed to do short years. They could run one, you know, at the time somebody's getting their post-forbearance option, but I think there's not a consistent practice, as I understand it, or plan about when that's going to happen exactly. So there could be a delay. So when that escrow analysis is run, in addition to whatever shortage is just building up because of the change in the tax and insurance year to year, you're also going to have $3,400 that has to be dealt with. For somebody who is going to get a spread of 2 years, which I think is what some servicers are planning to do on these, that's about $141 a month. And then when you add the $60 that, you know, that would have gone up anyway, they're going to come out of the forbearance paying $200 a month more than they were before, which for some people is really going to be difficult, especially because even for people who, you know, get back on their feet and can, you know, start making their mortgage payments again, there are a lot of reasons that you know, pocketbooks are going to be tight, and every $1, $5, $10 can really make a difference. So that might come as a surprise to people who are expecting to just sort of resume right where they were. If there's a longer spread to that shortage repayment of 60 months, it can be up to 60 months, and the GSEs certainly allow that, then we're looking at something more like $56 a month. And for that person, you know, their increase over what they were paying before forbearance is going to be about $115. So still, you know, something, but most of that is what they would have been facing anyway. So it really does make a difference, obviously, if it's spread out for a longer time. Now, the sort of perverse thing is that if you look at the next example, and this will be, I'll wrap up on this, but is that if somebody is in a 12-month forbearance that started April 1st, what's going to happen is, because the forbearance period lasts over, you know, I think I said on the earlier slide that the tax and insurance are due by February 10th. So if somebody started one April 1st of this year and it's ending at the end of March in 2021, that's going to encompass the due date for those charges. And that means that the servicer will actually have already paid those out. They'll have made the advances of what's going to be about $5,200. And as I explained, under that GSE payment deferral plan, that amount can be added to the capitalization. So you're not going to have that kind of extra shortage amount playing into the next escrow analysis. You're going to have, you know, probably some extra, but depending on time lag, but it's going to be closer to what it would have been just, you know, as a matter of course, the year-to-year changes. And then obviously, you know, we can do the math. You could come up with a very complicated chart of 6 months, 3 months, whatever. But all of this, as you can see, is very case specific and is something that I think it's important for housing counselors to just understand the dynamics of, because any given borrower who is reading all of the information that's out there, I think is understandably going to assume that they're essentially going to be making, you know, to the dollar or close to that, the same payment that they were making before forbearance. And because of these complications that we're discussing here, that may not be the case for everyone. And that's something that borrowers are going to need to have explained. I, in my experience, have seen lots of problems with escrow accounts, you know, analyses and changes and everything, especially when it's linked to loss mitigation. You know, there can be errors and things. So this is just going to be a piece of the puzzle that we need to be keeping our eyes on, and that we need to be educating our clients about, so that we can help them understand what's going on with their payments as they come out of forbearances. If it's not, you know, for any given borrower going to actually look like they expected it to. I will stop there, and I actually have to leave the call relatively early today, so I just have a few more minutes. If Melody, I don't know if you want to shoot any questions that have come in to me now. I'm also happy to field questions afterwards by email, so I am available to you, just not in a few minutes. Thanks.
Oh, sure. I'll try to be quick. What is the maximum time the servicer can spread the payment plan for escrow arrears? They thought they heard it would be spread for 2 years, but they missed what the maximum was.
Generally, it's 60 months, and that's what it is under the GSE guidance. So it's that's 5 years. Yeah.
Thank you. Do you know if once the forbearance plan ends, will the modification be guaranteed, or will borrowers need to apply for modification to see if they're eligible?
So again, that's going to depend. That's a whole topic. There could be or may have been a session about with you guys. I don't know what your schedule has been exactly, but I would say that, it depends on what kind of loan you have. Again, which agency is involved, if it is federally backed or if it's not. And then the other crucial distinction is going to be if you are in a position to resume making your regular payments or not. And if you went into the forbearance current or delinquent, all of those are going to there's sort of a decision tree that's going to result in, what your options are. But for somebody who had let's say have an FHA loan, they went into CARES Act forbearance while current, and then they come out and they're able to resume their payments. I don't see any reason that they should not be assured of getting the COVID-19 standalone partial claim, that option that FHA came up with. So, obviously we're not there yet to have tested what happens if somebody gets denied, but for people in that category, I'm fairly confident that they have, kind of an entitlement to that, and hopefully that's what they're going to get offered. For people in other situations, there's going to be more standard loss mitigation, so an application and review, and that is, uncertain in the way it's always been uncertain. But those are going to be, probably the more drawn out and complicated situations that you'll be seeing.
Okay, great. Thank you. That's everything we have on questions.
Great. Well, thank you all. And again, lsitkin@nhlp.org. I am available to you for questions going forward. And thank you all for your great work. I also just want to add before I go that because I know there's a lot of stuff coming up for tenants, maybe sooner than some of the more difficult stuff for homeowners, NHLP, my colleagues at NHLP do an enormous amount of work around tenant issues and tenant rights. And I hope that you will both look at our resources and see us as a resource for sending questions and things like that. And you're welcome to funnel those through me as well. Thanks.
Thanks so much, Lisa. That was really helpful. And a few people asked for a repeat of Lisa's email, and just in case you didn't see it, I did put it in the chat box, so everybody could access it in that way. Okay, so we're going to move on to our next speaker, and that is Courtney Ahinger with Mr. Cooper. And Courtney, let's see. So Courtney, I think you have yourself muted. So if you unmute yourself, I think we'll be able to hear you. Okay, you should be able to speak. Courtney? Courtney? Well, unfortunately, we aren't hearing Courtney. So I think what we'll do, Courtney?
I think we might have lost her temporarily. I would move to the next.
No, she's here. She's just having trouble. Okay, so what we're going to do is go on to Hugh Roden with Wells Fargo, and then once Hugh gets started, I'll work with Courtney to resolve her technical issue. So please excuse the fast movement through the slides. Oh, I went too fast. And there we go. All right, Hugh.
All right, thank you. Can you hear me okay?
We can hear you.
Great. Okay, well, so first of all, Lisa did a great job in going through a lot of the details, and I'm going to try not to rehash a lot of the things that you heard, but a lot of great details. So, one of the big questions that we're getting as servicers now is, how are we treating escrows for taxes and insurance, that are part of the, mortgage payment, and, with a forbearance or in loss mitigation, will they be deferred? And so, of course, there are some modifications that are being done that don't have escrows, but for those accounts that do have escrows, in most cases, just taking in consideration what's happening during COVID-19, there will be a shortage in our customers' account because we'll continue to pay out the taxes and the insurance plus the principal and interest to investors, and so we will have to solve for that. I don't want to make it a simplified thing because this is part of what we do as servicers each and every day. Yes, escrows can be challenging, and escrows can be challenging simply because there are a lot of moving parts. There are moving parts with the homeowners insurance and changes in the value, or excuse me, in the payment for the homeowners insurance annually, and then of course if you have city and county taxes, or just one tax on your escrow account, it can be a moving target. You layer that with payments that need to be made up during a time like now, which is of course an incredibly troubling time for all of us, then that will have to be taken in consideration. And so yeah, premiums change over time, and that can be tough, but for customers who have shortages in their escrow account, just like Lisa talked about a couple moments ago, there are options to be paid up to 60 months. And you heard her exclude FHA, but then if you look at the GSEs for Wells Fargo, or privates, or Wells owned, it's about taking it and making sure that it works for that individual customer, and it can be spread up to 60 months. Keep in mind, payment in full is an option, and we know that people aren't going to have a whole lot of disposable cash, but sometimes you may see that written somewhere, but that is an option. If I were a housing counselor and someone were I was talking to a customer about escrows and the potential for escrow shortages, this is also a really good time to have them check in and check with their county or city as it relates to property taxes, and see if there are going to be any increases that are pending or that are coming. I know for myself, I live in Georgia, and the county that I live in, I just went and appealed my property tax value, and so now we actually had a negotiation by phone, which was pretty neat, and I was able to fix my property taxes for the next 3 years. Well, that will have an impact on my escrow account that I'm paying. Likewise, I have a family member who is a senior, and I was blown away when she shared with my wife how much her insurance payment was. Annually, it was almost twice what mine was, and so we recently helped her last week, as a matter of fact, helped her get an adjustment to her insurance, because they said she had a claim like 10 years ago, and her insurance was crazy. So we got her another insurance policy, and of course, in turn, her escrow is going to change. So yes, a lot of things are impacting escrow accounts. We did, and we have done some analysis in taking a look at if it's a GSE loan versus a private loan, and we took a look at, okay, if you have to make up a shortage difference in 3 months, 6 months, or even 12 months, in most cases, the payment difference ranged between 1.5% change in payment, and in the worst case scenario, it was like 4%, just over 4%. What that means in dollars, of course, is going to depend upon what the overall mortgage payment is. But the nice thing is that as part of the COVID, or the CARES Act, for most loans and investors, we do get the chance to spread that over 60 months. I do want to encourage you to take a look. We spent a lot of time over the last 10 years really focused on communicating and on sharing information about escrow accounts. So it's funny that on the screen here it looks a little distorted, but you can go to wellsfargo.com/mortgage/manage account escrow, or you can just go in the search line and put in mortgage escrow account, and it'll still take you to this exact same page. But on this page, you'll be able to see how escrows are managed, and how we determine the amount that goes in there. We will do an annual review, and we will still continue to do an annual review of property taxes and insurance, just to make sure that the customer has enough to cover their expenses. And it will help us get ahead of any unexpected increases or shortages in those accounts. And then of course the surplus that we will typically keep in an escrow account, as Lisa mentioned a couple minutes ago, is 2 months. And so we take a look at the lowest point of the year as it relates to that escrow account, because yes, in the perfect scenario, as Lisa talked about a couple minutes ago, if your homeowner's insurance policy is due at the same time that your taxes are due, it makes it a lot easier. But for most people, their homeowner's insurance policy is different than their tax bill disbursements, and sometimes their tax bill disbursement happens at a couple different times throughout the year. So it can be a complicated process, but it is a process that we spent a lot of time in making sure that we provide information to our customers so that they can manage through those changing times. Again, as counselors, payment in full is an option. Coming out of this situation, there will be shortages in escrow accounts, but the proper adjustments will be made, and in most cases, depending upon an investor, it can be spread out over a 60-month period. But also, this is a really good time when you're talking to people to talk to them about appealing property taxes, and then also, taking a look and shopping and making sure that they have the proper amount of insurance coverage, and that they're paying, what is a fair market value based upon their history. So I'm going to pause there, and also advance the screen for me for just a second. So if you're a housing counselor or legal aid, and you have a situation that comes up with a customer, and you want to talk to someone about it, or have someone that can advocate on your behalf and be that emulsifier between you and Wells Fargo, then you can leverage my team that's shown here, where we have people that cover a variety of different states. And then you can always leverage Martin Sanchez, who covers the western part of the U.S., or Rulon, Washington, if for some reason you don't get directly to the community outreach consultant that covers that particular market. So I'm going to close there, and then I'll be prepared to answer questions at the end when we do the Q&A. Ellie.
All right. Well, unfortunately, we have not been able to resolve the technical issues that Courtney is having. And although she's able to call in, we aren't able to unmute her and be able to hear her. So,
Ellie, can you hear me?
My God, yes.
The technology god just you know, I don't know what happened, but it solved itself somehow.
Yay!
So I am so sorry, everyone. Apparently I'm technology challenged here today. So, I got most of what you said as we were trying to solve it. So I hope I don't repeat, but I know we've been on calls before, so I know we have a slightly different one, but I think we're still very similar. But hopefully I'll go quickly and not repeat too much. Lisa had some great stuff too. But if we want to just go, I just have one quick slide here, and then I know there's plenty of questions here. I know escrow is near and dear to my heart, but it is one of the most complex and confusing topics for a customer, and it is very impactful to their payment. And you know, I just want to touch on a few facts what we are doing during forbearance as well, and then go into some of the post forbearance pieces. We are continuing to run escrow analysis as normally scheduled, which again is an annual basis, and it's based upon a state schedule, which is based upon when generally your taxes are due, or that last installment, and we have the most up-to-date amount so we can project for the next 12 months. Other things that are impacting, you know, consumers today and what we are looking for, and this more is impactful on the non-escrowed side, but we are, you know, lots of agencies have extended due dates. There are insurance moratoriums where policies can't be canceled as a result of non-payment. So we're taking that into consideration as we are, because we do normally, and one of our responsibilities is tracking to make sure taxes and insurance are in place. So we're taking that into consideration from a consumer perspective. But we do, as always, and I know you touched on this a little bit, we have spent an enormous amount of time as well on our web. We've redone our escrow analysis statement to try to give some, you know, plain language to the very confusing topic of escrow to customers. But we do believe that borrower education is critical, because as Lisa pointed out, you know, borrowers believe, and they're getting, primarily it's the GSE deferral. The partial claim is a little different, but they do believe that when they say their entire payment is being deferred, that includes P&I. They don't really separate the P&I, the principal and interest portion, and the tax and insurance piece of it. And so with that P&I portion not being deferred as part of that, that's where you get into the true impact and potential payment shock issues. So some of the things we're doing is, as we've been very thoughtful on, I know there are standard suggested letters out there that would go from a GSE perspective in particular for the deferrals. But we are including and making it very clear on the disclosures that the T&I is not included, even to the point of giving that dollar amount so they understand that. There is, our agents are trained, and we have on the web as well to provide additional information, FAQs, explain it so they understand what the impact is going to be. And we believe it's important to understand affordability to run that analysis and let them know what the new payment may be. And that would include, you know, whatever the shortage is spread, because as you're not, and this becomes more impactful when you have consumers that are on a 6-month or 12-month deferral. Certainly is impactful on a 3-month or 3-month forbearance, or a 6-month or 12-month forbearance. It becomes more, as obviously they have not been paying into that. We are looking and looking to see if there is the opportunity, if there has been an escrow advance or a deficiency, or the balance is not negative, to be able to include that in the deferred amount as often as possible. But we are looking at really what is the payment increase going to be as a rule of thumb, so we can have some direction to say if your payment is going to go up over 10%, for example, we would spread that longer than the standard 12 months. Obviously, having those conversations with the customer to understand their ability to repay. You know, we do think that longer spreads create an additional level of confusion as well. and it does have their payment become a little bit higher for a longer period of time, because the longer you spread it, it's taking up to 5 years to pay back that shortage, as opposed to getting them back to hopefully a normal T&I payment. But affordability is an important factor. We see increased, escalations as they spread, because the customer wants to understand, why do I continue to have a shortage? So we think around going up to the 24 months is probably the best option. But again, we would go up to 60 months as the GSEs may allow. And in some instances, a mod would be a 60 months if they go into a modification option. So, I just wanted to add a piece of it. I think we've all kind of have a different perspective on it. But again, I think just to kind of emphasize the education piece of it, trying to understand what the borrowers can afford, and making sure that they understand that the shortage may be over a longer period of time, really will reduce any confusion for the next year as we continue to do an escrow analysis. I think that covers kind of all my pieces that I just wanted to touch on, and hopefully I didn't repeat too much, but.
Okay.
So, Ellie,
well, thank you so much.
Yeah.
Yep. Yeah.
Yeah.
We are, I do think that we have some questions, right, Melody?
Yes. This one will be for Hugh. How does the customer request a longer repayment option? Can the customer service line people handle this, or will it go to loss mitigation department? Will budget review be necessary in determining how long the repayment period will be?
Yeah, so there's a lot packed in there. So the first question is, if you were to call in, let's say it's not a normal default period of time, or high default period of time. Yes, if you call into one of our home preservation consultants, then yes, they can take a look, tell them that exactly what you need. I want to have a conversation about my escrow account. And if you're anticipating an increase and you have information that possibly we don't have, you could share that, and they can work with someone or do an escrow analysis, even if it's off of the normal cycle, annual cycle. They can do that for a customer. If a customer is actually like now in a payment suppression plan, whether it be forbearance or even a traditional modification, if they were delinquent before March 1st of this year, then yeah, that's going to be part of the conversation that they have. And so Courtney said something that was really important, is that yes, you can go up to 60 months, but you really need to take a look at will this create confusion down the road, and or could you handle that difference spread out over 12 months. We all know escrows they're just moving targets, and our escrow accounts are moving targets, and the balance of those accounts are moving targets, because we don't control any of the factors that drive change in that escrow payment. So hopefully that answers the question.
Thanks. Is a 60-month repayment period available if the borrower gets the GSE COVID-19 payment deferral?
This is Courtney. The GSEs don't, it's not prescribed, but it says up to. They are not telling us what each servicer is required to do. It's just the general guide that says you can go up to, and that's really a servicer's discretion. I think the Hugh's point is what's the most affordable at which payment option based upon the spread.
Thanks. This is for you, Hugh. The person isn't exactly sure of the procedure that you named, but with regards to that procedure, did you do that to your property taxes that you were able to pay ahead for 3 years? Could you just elaborate on that?
Oh, okay. Yeah. It always happens when you put something personal in there, but that's just who I am. So I live in Georgia, and I live in a county called Gwinnett County. And one of the things is that every year in the state of Georgia, they send out your assessed value, and you have a chance to take a look at your assessed value. And if you disagree with it, I mean, every year you could appeal it. And so this year I happened to appeal it, and they did lower my assessed value just a hair. But the other thing that they did for me, which was an option at my county, was to take that and to lock in what I would pay for the next 3 years. Well, there's good and bad in that. If property values happen to plummet, then I'm paying at a higher rate for the next 3 years. But if they happen to go up, then I'm at least fixed at that payment for the next 3 years. And those types of things do have impacts on your escrow account balance. And so my point was, if I were a housing counselor, I would not, one piece of it is the servicer. The other piece of it is, the responsibility of making them aware of, the fact that, yes, understand when your property taxes are due, and if there's a change, and knowing if there's a change, making sure you're communicating with your servicer. And the same, with your hazard insurance. Hazard insurance can change. And that's what another example that I gave was a family member who actually over the last 10 years had been paying an enormous amount, and with a very reputable insurance company. But it was told because she had a claim. But she didn't know. She's elderly, senior, limited income, and so it was just a really heart-wrenching situation that we had to work with last week to get her to a better place. So hopefully that gives you some more context on where I was going with those two comments, because I did make it personal.
No worries, thanks. How is the length of repayment amount determined? Is there a guideline used for the borrower to be granted a specific period of time?
I think you just heard Courtney say a couple minutes ago, and I shared also that it can be up to 6 months. But what we do want to do is to the longer the longer you put out that repayment plan, creates an opportunity for confusion down the road. But if it's affordable and payment can be spread over 12 months, then we want to do that to be able to help our customers during these challenging times. But it's up to 60 months.
Yeah, and this is Courtney. There is no standard that says if your payment goes up more than, let's say, 10%, then you should spread it 24 months or 20%, 36 months. It is very, I think, borrower specific, because 10% may be impactful for them. We have modeled it, and we provide that as guidelines to our agents. But again, it is very customer specific.
Thank you. Will the mortgage company take into consideration the housing to income ratio to determine whether the stretch? I'm going to start over. Will the mortgage company take into consideration of the housing to income ratio to determine whether to stretch the escrow shortage over a 24-month versus 60-month period? Whose discretion is it? And also, is it a mutual agreement, or will the servicer say 24 months is the repayment of the escrow shortage, take it or leave it? I know it's a really technical.
Yeah, this is
question.
Courtney. I can at least speak for us. We aren't taking the housing to income ratio into it. We are. It is a conversation though with the customer, between the agent and the customer. That's why we are doing at the time of the deferral, for example, to say here's what your new payment would be, because that education component, and then there is a conversation that we do have guidelines again that we give to the agent, there is a process if they need to go higher. but based upon the conversation that they're having with the customer. So it is a conversation between the borrower and the agent, and we have a process to be able to complete the longer shortage spread as they need to while they're on the phone with them. Up to 60 months.
Yeah, so you're just going to hear a lot of things that Courtney and I are going to end up kind of repeating each other on a couple different things. And so, yeah, we don't take a look at the debt to income ratio for a customer. I mean, think about this for a moment. You know, you may have purchased your home 7 years ago. Stuff's going to change, all the time, and so your ability to repay can always be impacted. The modeling that we did in the worst situation, taking in consideration that we needed to solve for 12 months of taxes and insurance repayment, the most when we modeled it was just over 4%, and that was taking it and spreading it over 60 months. Taking into consideration, I think the example we used was a total PITI of $2,000. Taking into consideration that being paid over or being repaid, over a 60-month period. Worst case scenario, it was 4.2%. But as we backed down and modeled 9 months, and we modeled 6 months, and then we modeled 3 months. The change in payment was 1.5% in worst case scenarios. So it just really depends. There's not, this is it. I mean, I think the only time where it would be, this is the best that we could do, would be in taking a look at spreading over a 60-month period. Of course, if your product allows for that.
Great. Is there a local program available to help homeowners with delinquent mortgage payments? Would it be the best use of funds? Would the best use of funds be, okay, forgive me, if there was a local program available to help homeowners with delinquent mortgage payments, would the best use of those funds be to pay escrow overages in order to help with payment shock?
So that's a really good question. I was actually on another call just a couple of days ago, and there are a lot of cities and counties that are coming up with a variety of different programs to help, their community when they're having housing payment challenges. Yeah, it could go to pay. So again, remember I said earlier, you can pay it in full, your shortage. And so if there was a program that you're aware of for that borrower, yes, they could make, with Wells Fargo, they could make a payment towards the overage, or excuse me, the underage in their escrow account.
Thank you. Hugh, does Wells Fargo have the education component?
Absolutely. So we have the education component. Again, you can go to wellsfargo.com. And you can go one of two places. You can go to the counselor support site, and you'll find education there on escrow accounts, or you can go to just simply wellsfargo.com and put in mortgage escrow, and the slide that was showing when I showed my presentation will also guide people to a place where it goes into a lot of in-depth detail, video, pictures of escrow accounts, and different scenarios. So yes, that is available.
Thank you. What are the guidelines, Courtney, what were the guidelines you referenced that servicers are going to have to use to determine length of repayment?
I just referred to within the servicer guides for Fannie Mae and Freddie Mac. They only give the guidance that says up to 60 months. They don't give specific guidance, but I'm referring to the servicer guides.
Thank you. Are collection and loss mitigation staff aware of housing counselors and their roles?
For Mr. Cooper, yes, they are. Yes, they are. Sorry.
That's everything.
All right, so let me answer that last question. You know, we have a team that we have set up that works with housing counselors, legal aides, and a variety of other types of organizations. And you know, could you be talking to someone in collections and they not be familiar with you know who a housing counselor is and what the role is of a housing counselor? That could be possible. And so you know, you're talking about the knowledge of a lot of people because our servicing team is pretty large. So it could happen, but if there is a situation, again, where you have a challenge, I know that Bruce or Ellie can send out our geography map where you can reach out to one of the community outreach consultants on my team and you know, get any problem or concern that you have you know, adjusted or fixed.
And I'll just jump in that the map is available on the directory that we've got for counselors to communicate with servicers. You just go to Wells Fargo and there's a link to it. So you can always get the latest updated version there.
Yeah, thank you, Bruce.
We had 2 more questions pop up if I can ask them very quickly. So Hugh, are you saying that counties may be able to adjust property taxes?
Boy, I opened a can of worms there, didn't I? You would have to reach out to your individual county to find out what their guidelines are for appealing property taxes. I know that in the state of Georgia, it has become just more flexible over time, but that is from a lot of great people advocating for you know, our low to moderate income communities and minority communities with just the changes and the ramp ups in value. So you would really need to check your own county or city, depending upon the type of taxes that you pay in your mortgage.
Thank you. And could we get a map for Mr. Cooper if possible?
So this is Ellie, and I'm just going to jump in on that. Mr. Cooper has a pretty robust escalation process available for housing counselors, and that is also on the list that Bruce mentioned. The Wells Fargo map is really just because they have very regionally specific people to reach out to for escalation, whereas with Mr. Cooper they have a general line for everybody. And Courtney, please correct me if I'm wrong about that, but that is what we have on our list.
You're correct. Yes, we do have a dedicated department and escalation process, and I think as Ellie said that's available that way as well. So I think the map is we're just different focus, but we have a similar escalation process with a whole team dedicated as well.
That's it on questions. Thanks so much.
All right, great. Bruce, I turn it back over to you.
Thanks so much. Well, nice work, everybody. We'll be really quick. So just a reminder, we're still around if you want to join NHRC or just send out a renewal notice. We still have the discount on housing on credit reports, which has been a good success for people. And we also have the so Savvy, the online app on how to help people with their student loans, which is a terrific program. You can use it for free just to figure out what you or your clients need to do, or your household members, and that's a win. It's very good also on figuring out the public service forgiveness option, which of course most of your staff probably qualify for if they need it. But if you want them to do the paperwork and also provide reminders, it's normally $89.50. With us, it's $35. And this is a useful tool right now because people's incomes have gone down and they may need to get into a income-based repayment plan and put all those pieces together. So useful tool to use. And if you're an NHRC member, you'll get we've got an email from me this year, and I'm happy to send it again, or if you renew, you'll get a reminder with what the link is to get into the section that gives our people the discounts. So feel free, and I understand that groups also, may not be the best time financially. Please take care of business at home first, but we'll be around for a while. And I'm delighted to say we've brought in, we're 6 months into the year, and we've brought in half the membership dues for the year already. So we are doing fine, and anybody who can help out, that really matters. Really appreciate that a few people have upped their membership dues commitment. So anyways, nice personal note from me. We appreciate it over here at NHRC. Quickly for next week, next call, what we're planning on is doing one on the 16th, and we're going to try to get back to a twice a month schedule. We're not going to do anything over the 4th of July, the week around the 4th of July. The plan is for the 16th. We'll go back to weekly things if there's things happening that are urgent. We do appreciate, we actually appreciate all you've been telling us about what has worked and what's been valuable. And we'll try to be responsive and timely around all the issues. So right now we're assuming that the 16th, and there'll be another one at the end of July. But
Bruce?
Yes.
I'm really sorry. I just want to hop in quickly. So, one of the things that I had wanted Wells Fargo to tell us about was a webinar series that they have coming up that some of the housing counselors might find useful. So if we could give Hugh just a minute to mention it.
Yeah, thanks a lot. And I apologize, I didn't see the comment in the chat there. So starting the 1st of July, so we're going to do a webinar series that is called Focus on Home. And it's really about tips and tools for, housing counselors and financial counselors and coaches and other housing professionals. And so we work really closely with Bruce to, take a look at topics and stuff like that. But the first call will be Wednesday, July the 1st, from 2 to 3 p.m. And it will be, I will interview Carmen Bell, who is the head of our default servicing. And we'll talk about assisting Wells Fargo customers with mortgage payment challenges during COVID-19. And so I've tried to anticipate as many questions as you would have. In building out, the questions that I have for her. And so if you have not received an invitation to participate in that webinar, just send an email to communityoutreach@wellsfargo.com, and then my team will make sure that we get, an invitation sent out to you. So again, the email address is communityoutreach@wellsfargo.com, and then we will send an invitation. We'll follow up for the first 90 days. We're going to do kind of a bi-weekly cadence. And so the second one will be one that is focused on renters with a legal aid, and Eileen Fitzgerald will moderate that conversation. And then 2 weeks later after that, we'll talk about helping customers get into homes during COVID-19, and Sarita Battles over our diverse segments will be participating in that one. So we hope to bring you content that is complementary to what you're hearing here, and make sure that we're powering, we're pairing the power of lending and philanthropy together to help address some of the community's most complex needs. So thanks.
And what's the name of the series again? Once more? What's the name of the series?
It's called Focus on Home, Tips and Tools for Housing Counselors, Financial Counselors and Coaches, and Housing Industry Professionals. A mouthful. Tips and tools.
Great. Thank you.
Okay, good. Well, thanks everybody for your good work, and we will talk with you on the 16th.